Right, hello everybody. This video is going to be looking at the balance of payments. This is another key measurement of macroeconomic performance. What I would like you to do, please, in your writing books for your independent learning, if you can put down these three questions, please. So list the components of the current account. Explain the difference between a current account deficit and a current account surplus. And then finally, number 3, explain the difference between a trade surplus and a trade deficit. If you can now hit pause, write down your answers. And once you've written down your answers, click play, please. Right, so hit pause. Right, everyone, welcome back. What we're now going to do, we're now going to think about the answers to these key questions that you've been looking at. Right, overall, so let's think first of all then about what the balance of payments actually is. Now, the balance of payments simply records the inflows of money and outflows of money between economies. So the inflow of money is money that comes into our economy from foreign economies. So this would be an injection of money into our economy from overseas. Outflows of money will clearly be money that starts off in the UK but then flows out of the UK economy. Now, the balance of payments then has got 3 overall accounts. We have the current account, which is linked to trade, something we call international transfers and income payments. And then we have something we call the capital account and the financial account. Now, this video is going to focus on the current account. There'll be a later video looking at the workings of the capital and a financial account. Now, what I will say though is that the overall balance of payments must balance. In other words, the inflows of money coming into the economy must be equal to the outflows of money leaving the economy. The UK operates a large current account deficit, which means the outflows of money exceed the inflows of money on the current account. That therefore means on the capital and financial accounts, the UK runs overall a surplus. So this surplus means inflows of money exceed outflows of money, and this will cover the current account deficit and ensure that the balance of payments overall balances, which means the final number is 0. Right, so we've got to be thinking about the components of the current account. Now, a key section of the current account is trade performance. Now, trade performance is looking at exporting and importing of goods and services. So what we would do, we would try and discover the value of all the UK's exports of goods and services. Now, clearly what this will be is all the goods and services that start off in the UK, so made in the UK, but then they are sold overseas. We then take away the value of the imports of goods and services. So to give you a simple example here, we'd add up the value or the inflows of money into the UK economy from exporting all of our products made in the UK and then sold overseas. This will be cars made in the UK. It will be foreign people demanding UK education, such as universities. It will be foreign people demanding UK holidays. So this will be the inflow of money coming in. The imports would be all the foreign cars that come into the UK economy, all of us demanding foreign holidays, our demand for foreign clothing, electronics, etc. Now, if the value of the exports of goods and services is less than the value of the imports of goods and services, then it means the economy is operating with a trade deficit. Okay, so if what we export to the rest of the world in terms of value is less than what we import in, then we have a trade deficit, which is what we have in the UK economy. Now, a trade surplus is the opposite, where the value of exports of goods and services exceeds the imports of goods and services. This is something that you see in economies such as Germany, China. Trade deficits are countries like the UK, India, and America. The next section of the current account is income payments. Now, income payment is linked to investments. So, for example, UK citizens will have made investments overseas. This could be buying shares in foreign companies. It could simply be setting up businesses overseas. It could be that British people own property overseas, which is rented out. So the idea would be that British people will generate incomes from investments made overseas. So when we have wealth overseas, such as like I said, businesses, etc., then we can earn dividends, profits, and rental income from these investments. This would clearly be an inflow of money. What we would have to do, though, is to take away the outflows of money. So foreign people will have made big investments in the UK economy. So foreigners, for example, will own property in the UK. They will own businesses in the UK. And they will also own shares in British companies. This will therefore be an outflow of money. Now, also in this section, we would include remittances. So remittances is linked to UK citizens or foreign citizens moving in or out of our economy. And when they work overseas, a proportion of the income they earn overseas could be sent back home to their home economy. So, for example, if British people work in the Middle East or in America, they may send a proportion of that income back to family and friends in the UK. That would be an inflow of money into our economy. But of course, we have in the UK lots of people from generally poorer economies, such as Eastern Europe, India, Pakistan, Bangladesh, sections of Africa. And what will happen here is when they work in the UK, a proportion of their income will be sent back to their home economy. That clearly will be an outflow of money from the UK economy. International transfers is often linked to aid. Okay, so this could be UK charities sending money overseas to help out with humanitarian causes in sections of Africa. We could be looking here at our government sending aid to weaker economies across the world, such as Bangladesh or Pakistan. Now, overall, then, the UK economy operates a current account deficit. We have a trade deficit on the trade performance section, which means the value of our exports are less than the value of our imports. We also have a incomes payments deficit, which means the earnings we generate from overseas assets is less than the income that leaves our economy from foreigners owning assets within the UK economy. The final one, international transfers, again, the UK has a deficit here. In other words, our government, our charities, send more aid out of the economy than what flows back into our economy. Okay, so you've got here just a lovely overview of how you would work out current account performance. So to work out the trade performance is the value of the exports, take away the value of the imports coming into the economy. Income payments is the same. You would look at the inflows of money from our investments overseas coming in, but take away what leaves our economy by foreigners generating returns on investments in our economy. International transfers, same thing. We look at the inflows of aid coming into the economy minus the outflows of aid leaving our economy. So overall, we have got in the UK a large and growing current account deficit. And like I say, what we do, we balance this by running a capital and financial account surplus, which you will see in a later video. Now, the level of inflows and outflows of money from economies shows how interconnected our global economy is. And this will be something that we explore in more detail in theme 4 when we look at a topic called globalization. Right, guys, I will stop there and say thank you very much.